The world is changing faster than ever. Technology, globalization, climate change, and pandemics are reshaping our lives and societies in ways we can barely grasp. But amid all this turmoil, there is one thing that seems to be fading away: inflation anxiety. For decades, inflation was the specter that haunted the dreams of central bankers, investors, and ordinary citizens alike. It was the force that eroded the value of money, distorted the signals of the market, and threatened the stability of the economy. It was the enemy that had to be fought at all costs, even if it meant sacrificing growth, employment, and social welfare. But now, after a brief and unexpected resurgence, inflation seems to be retreating again. The latest data from both sides of the Atlantic show that the surge in prices that followed the reopening of the economy after the pandemic lockdowns was largely transitory, as many experts had predicted. The underlying pressures on wages and profits are easing, and the expectations of future inflation are moderating. This gives the top central bankers in Europe and the US more confidence that they can start cutting interest rates by the summer, without risking a runaway inflation spiral. This would be a welcome relief for the millions of people and businesses that are still struggling to recover from the pandemic shock, and for the governments that are trying to finance their massive stimulus spending. The shift in tone from the monetary authorities was evident last week, when both the Federal Reserve and the European Central Bank held their policy meetings. The Fed chair, Jay Powell, said that the U.S. Central Bank was not far from having the confidence to start lowering borrowing costs, which have been near zero since March 2020. The ECB president, Christine Lagarde, said that the policymakers had begun discussing the dialing back of our restrictive stance, celebrating good progress towards our inflation target, even if we are not there yet. The markets took notice. The yields on government bonds, which reflect the expectations of future interest rates and inflation, fell sharply. The investors who had bet on a prolonged period of high inflation and tight monetary policy had to unwind their positions, causing a sell-off in stocks and commodities. The dollar and the euro strengthened against other currencies, as the prospect of lower interest rates made them more attractive. The change in sentiment was also driven by the latest economic data, which showed that the inflation spike was losing steam. On Friday, the U.S. Labor Department reported that the economy added 275,000 jobs in January, beating forecasts, but big downgrades to previous figures bolstered expectations that the first rate cut could come by June. The unemployment rate fell to 4.2%, but the labor force participation rate remained low, suggesting that there was still plenty of slack in the labor market. The same day, the Eurostat released the fourth-quarter data for the Eurozone, which showed that the unit labor costs and the profit margins rose by a slower rate than in the previous quarter, easing fears that the companies were driving up inflation by passing on higher labor costs via aggressive price increases. The annual inflation rate in the Eurozone fell to 4.9% in January, down from 5% in December, and below the consensus forecast of 5.1%. These numbers confirmed what many economists had been arguing for months, that the inflation surge was mainly driven by temporary factors, such as supply chain disruptions, pent-up demand, base effects, and energy prices, which would fade over time. They also pointed out that the structural forces that had kept inflation low for years, such as aging populations, technological innovation, global competition, and weak bargaining power of workers, were still in place. Of course, not everyone is convinced that inflation is under control. Some of the hawks at the Fed and the ECB think that the economy is too strong and the monetary policy too loose, and that the central banks should act sooner rather than later to prevent inflation from becoming entrenched. They point to the risks of higher inflation expectations, rising wages, and fiscal stimulus, which could fuel a self-reinforcing cycle of price and wage increases. In the U.S., Neil Kashkari, the president of the Minneapolis Fed, and Raphael Bostic, who heads the Atlanta Fed, think that the strength of the U.S. economy means that the Fed does not need to cut rates as much as the policymakers thought was necessary in December, when they forecast 3 moves over the course of this year. In the Eurozone, Joachim Nagel, the head of Germany's Bundesbank, acknowledged that the probability is increasing we could see interest rate cuts before the summer break, but warned against falling into euphoria too early. These dissenting voices reflect the uncertainty and the diversity of views that still exist among the central bankers, who have to navigate a complex and unprecedented situation. The pandemic has created huge shocks and imbalances in the economy, which are not easy to measure or predict. The central banks have to balance the risks of acting too soon or too late, of being too cautious or too bold, of being too transparent or too vague. But the majority of the central bankers seem to be leaning towards a more dovish stance, which is in line with the preferences of the political leaders and the public opinion. The Biden administration in the US and the Macron government in France are pushing for more fiscal stimulus to boost the recovery and address the long-term challenges of inequality, climate change, and competitiveness. The public opinion surveys show that most people are more worried about unemployment, health, and education than about inflation. This is a remarkable change from the past, when inflation was the dominant concern of the policymakers and the public. It reflects the lessons learned from the last decade, when the central banks were too quick to tighten the monetary policy after the global financial crisis, and ended up prolonging the recession and the deflationary pressures. It also reflects the recognition that the world has changed, and that the old rules and models may not apply anymore. The end of inflation anxiety does not mean that inflation is dead, or that the central banks can ignore it. Inflation is still a potential threat, and the central banks have to monitor it closely and adjust their policy accordingly. But it does mean that inflation is no longer the main constraint on the economic policy, or the main source of fear for the economic actors. It means that the central banks have more room to maneuver, and more flexibility to respond to the changing circumstances. This is a good thing, because the world is facing many other challenges and opportunities that require bold and creative solutions. The pandemic has exposed the fragility and the inequality of our economic and social systems, and the urgency of building a more resilient and inclusive future. The technological revolution has opened new horizons of innovation and productivity, but also new risks of disruption and polarization. The climate crisis has demanded a radical transformation of our energy and transportation systems, but also offered a chance to create new jobs and industries. These are the issues that should occupy the minds of the central bankers, the policymakers, and the public. These are the issues that should shape the economic policy and the economic debate. These are the issues that should define the new era of economic history. Inflation anxiety is over. Let the new era begin.